1.5 cents. Continuing to see a little bit of a positioning ahead of Wesfarmers results out tomorrow. It is up at 12 cents and Woolies steady as she goes, up 4 cents.
All right, let's get across to Chris Weston, who joins us this morning from IG Markets in Melbourne. Chris, you're seeing on the headline anyway, volatility quite low at the moment, but I guess the question is whether that continues. It's supposed to be a big September. What are you looking out for at the moment?
Europe and a bit more Europe. I think probably chucked in with the FOMC on the 14th. But I think, you look at the volatility index at the moment, the VIX trading it, well, it's up a touch last night, just around that sort of mid-14 level at the moment. Historically very, very low. Do I think this is going to rise going into September? Yes, I do. I know
Chris,
that...
is it complacency or confidence in regards to equities, do you think, that is seeing the VIX at the levels it's at the moment? Because it is very low.
Well, I mean, there's two things that really feed into the VIX. One is the measurements of volatility or the moves that we see on the S&P. The other is whether people are actually buying put protection on the S&P. Perhaps I do think there's an air of complacency. I mean, people are thinking to themselves, am I going to go out and sell clients' holdings, big clients' holdings, knowing that the economy could either get better and then we don't see QE3, which is generally what we're seeing at the moment, hence why the move we've seen up in 10-year yields in recent times. And also the situation is do Spain, if things get worse, if we do see those yields, so the front-end yields pushing back up again, does that push Spain into tapping assistance and effectively, the ECB and the EFSF bankrolling or supplying or buying and funding Spain for the next couple of years? So I think that's going to be the big issue. I think people are a little bit complacent at the moment, to be honest. But do I think central banks are going to come to the rescue if needed? I do, and I think that's why the market's pushing this volatility down to these current low levels.
Which means, are we fairly safe in saying that any immediate risk of some kind of very big pullback, although maybe we feel there might be some pullback coming, a big pullback, that's off the table now? Look, I know we never say never, and don't say that. Don't answer me with that, because I know that.
I think we can discount a major pullback. Probably the big thing for me is what's happening with Greece. I think that Spain's the big issue at the moment, but I think at the end of the day, we will see Spain looking to get some sort of assistance. I mean, you've got to think into the mid-Septembers. We're going to have an EU summit. The ECB meeting on the 6th will be on the 8th of September. We'll look at it very closely because that's when we're likely to get the more colour on this conditionality that's going to be attached to us attaching assistance. Are we going to see further austerity for Spain? Are we going to see them lose a loss of sovereignty? Or are we going to see Troika coming in and doing what they're doing with Greece, Ireland, and Portugal at the moment, and having a permanent Troika in there, monitoring their deficit targets? That for me is a source of concern, but I think at the end of the day Spain will come out and tap them. Italy perhaps not so much. I don't believe Italy need to do anywhere near the same sort of measures that Spain do, but Greece is the big issue. If you think towards 14th of September, 15th of September, Greece need to identify $11.5 billion or euros worth of deficit cuts, or there's going to be a very good chance that we're going to be being pushed into this second debt restructure, which will involve official sector involvement, which will be the ECB's holdings. Remember, they hold about 160 to 180 billion of the 266 billion of Greek debt at the moment. That could be a negative scenario. Would it be a major negative scenario? We just don't know. I mean, Jean-Claude Juncker the other day came out and said that a Greek exit would be manageable but not desirable. Well, I think they said exactly the same things about Lehman Brothers. We just don't know how this is going to go. I don't like it when I hear people saying that Greece is a very small percentage of growth. That doesn't matter at all. It has no bearing at all. It's to do with the roadmaps for other nations to come in. So I just don't know how this is all going to plan out. Greece would be probably the big situation, but I think the markets are probably right that we shouldn't overly panic. Yeah, there'll be a pullback if people get the anticipation of a worst case scenario coming through in Europe. Of course there will be, but I don't think we're going to see massive declines, because the ECB will come out and Spain will look to tap there, and we'll see yields coming back down to sustainable levels over the longer term. I just think the overall global growth story right now is hardly compelling at all, and we're seeing that in the GDP numbers. We're seeing that in the export numbers coming out of Taiwan, Korea, China. It's not particularly compelling. Although, I think you look at some of the rhetoric we're seeing from CEOs today at the moment. Some of it, especially Vale, Rio, all relatively positive that things seem to be stabilising a little bit.
Chris, let's bring it a little bit closer to home. Look at our own market. Look, we've seen the S&P ASX 200 actually turn negative. No big cause for concern at the moment, I suppose. We're down just 4 points, but interesting to see the miners offsetting early strength from CBA. Indeed, the banks also fluttering between positive and negative territory. CBA off its highs, up just about 0.8% at the moment.
Yeah, well, I mean, why the materials space is under so much pressure, I couldn't tell you. I mean, maybe we had seen this big rotation out of more defensive assets into more cyclically focused assets. Maybe we're just seeing a bit of profit taking on the downside. I have seen that Asian markets under a bit of pressure. US futures are down a touch today, so perhaps that little bit of risk coming off in the short term. But I think the banks, I mean, CBA's result today is a good result in so much that it's brilliant on the dividend side, smashed expectations at $1.97, was right at the top end of the range of what people are looking for. And again, CBA has been trading as an income stock. It's been trading almost as like a quasi bond in its own right. What happens on Monday when it goes ex-dividend and people, you get some of the fast money dividend strippers looking to come out again. The long-term guys probably won't necessarily sell because they don't get the franking credits if they sell out too quickly. But I think when it goes ex-dividend, that would be very interesting to see what happens with CBA. But I think the result from these guys was pretty much bang in line across all different metrics. Some of the analysts will be pointing out return on equity now 90 basis points was a little bit concerning. The cost-to-income ratio was a little bit worse than expected. But on an earnings metric and divisionally, they came out just as the market wanted to see it happening. We've seen a really smooth transition over for Ian Narev. We've now got that front and centre. We've seen that for everyone to see now, and the market's trying to justify whether its 18% premium to the peers is fully justified. So we are seeing a bit of weakness coming in as the day goes on. Perhaps the stock will end in negative territory, but I think it was a good result. The dividends are clearly the thing that the market likes today. I mean, elsewhere we've got some spectacular moves coming out of Oz Minerals, Primary, Sims Metal. It's what we have seen this earnings season is just some really big moves on the day if we're actually getting the fact of announcements today. So
is that low volume though? Is low volume sort of, I suppose, exaggerating some of the swings?
And short covering as well, in particular stocks though.
Well, I mean, primary healthcare, I think it's a really interesting one. I'm not sure if there's a huge amount of short interest built into the stock. I mean, the stock's outperformed the market quite nicely this year. I think it's a really robust outlook. That's one thing. But yeah, I mean, you're right. Both those things haven't, short interest. When you actually, JB Hi-Fi, a perfect example of that. We know there was a lot of short interest in that stock. A lot of it masked by some derivative positions coming through. But was the result inspirational? Not in the slightest. Had a big gain on the day. I think you've got to look at all these different factors when you're taking into account. Sims Metal today has been absolutely smashed because it's absolutely missed expectations. So when you're playing the market at the moment, you've got to look at all these different variables that feed into the result. Oz Minerals, for me, very interesting today. I mean, this actually shows a good thematic around the sort of what the mid players are looking at the moment. It's about the dividend. It's about the conservative nature, more prudent capital management around this. You've got this situation. I think last year they paid a full year dividend of 30 cents, interim dividend then of 30 cents plus the $200 million buyback. They've come out today and announced a 10-cent unfranked dividend. People are saying, they've got lower than expected cash holdings. We're getting to that stage now where they are being a lot more prudent with that cash, and I think that's why we're seeing the stock down as much as it is at the moment. But yeah, there's a lot of different variables that feed into this earnings season. But I think if you're really looking at anything, you've got to look at the outlook, and the divergence in outlooks between CEOs here in Australia is actually amazing at the moment.
Chris, with a company, a stock like Oz Minerals, do you think that the sell-off we're seeing today is investors thinking, well, if we're not going to get the kind of healthy dividend we've been seeing in the past, we can put our money into somewhere that's maybe a bit safer with more of a return? So maybe not a reflection in terms of the metrics and the operations of the company, but rather what they're going to get out of it as a shareholder.
Well, I think there's a lot of things that feed into this Oz result. I mean, I generally wouldn't be looking to pick up mining stocks or mining services or mining stocks or resource stocks for their dividend. Generally, they pay very low dividend yields unless their price has been smashed and they've come down to more sort of compelling dividend yields. But with a company like Oz, it stands apart. We know they've got a huge amount of cash. I mean, it came out today around 650 million, which was below what the market was looking for. But it's about what they plan to do with that. We know Carrapateena seems to be doing quite well. Prominent Hill's got a short mine life as well. So what happens here? We've then seen another situation where costs have been rising. That's another thematic that we've been seeing in the mining space. But I think they've taken their cash guidance or their cost guidance to $1.10, $1.20. A lot of the analysts have been modelling forward guidance with about $1.17 copper price. So I think the analysts aren't going to be too concerned, but the market might be a little bit concerned by that higher cost guidance. But what are they going to be doing with that money? I mean, I think this is something very different from a lot of companies with Oz. We've liked the company because they've been doing these buybacks, because they've been paying really healthy dividends. Now they're being much more prudent. But that's another thematic that we're playing in the mid-tier space, that these guys are struggling to get capital at the moment, and as a result, they're having to be more prudent with their cash holdings.
Actually, I was just seeing a City note that's come out to say that they think Fortescue actually might need to refinance. They're too high. Well, obviously, we know they're highly exposed to their own oil price, but it's got a lot of capital spend in the year ahead. And they're now talking about, this is just flicked up now, but some refinancing likely to be required. So perhaps that's coming into play a little bit as you were just describing, Chris.
Well, these guys have been doing all right. I mean, I think they've been managing. The bond market's been their absolute friend. I mean, they've been managing to get away a lot of money in the bond market at very healthy levels indeed. I mean, that's the difference. A lot of people have been saying about Fortescue, that the bond market's rating it at one level, and the equity investors are rating the stock at a very different level at all. And perhaps equity investors need to use the bond market as a guide to see how they're going. I don't know anything. I'm not sure whether they'll be looking to capital raising further down the line. I'd have to read the City note, but I think from what we're seeing at the moment, they have raised a lot of money both through equity, through the bond market, that should see the projects reasonably well funded. But I don't think these guys are going to struggle to get money away further down the line. I think a lot of people still like the company.
All right, Chris, got to leave it there. As always, great to talk. Thanks a lot.
Cheers, guys.
Now, Westfield is